Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. And by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome to America's Commercial Real Estate Show, where we're rocking out all the time. Well, thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with. And laugh, I believe we have to have some fun along the way. Well, hello, I'm Michael Bull, your host to the world of commercial real estate. Thank you for joining us. Remember, if you have any questions or comments related to this show or any commercial real estate related issues, we do appreciate hearing from you. Our phone number is 888-612-SHOW. Our email is info@creshow.com. You can also connect with us through Twitter or LinkedIn, and you can find them all at the show website, commercialrealestateshow.com. Well, today we're looking at the U.S. retail market. Retail real estate was probably the worst hit commercial real estate sector in the recession, with weak job growth, waning consumer confidence, and uncertainty in the political environment. What should we expect from the sector? Has it turned around yet? Where are we in the cycle? And what should we expect for future performance? Well, we'll find out today. Please welcome my first guest, Dan Fasulo, Managing Director for Real Capital Analytics. Real Capital Analytics is a global research and consulting firm with offices in New York City, San Jose, The Hague, and London. Since 2000, their research is focused exclusively on the investment market for commercial real estate. In addition to collecting transactional information for property sales and financing, they analyze and interpret the data, providing valuable insight on commercial real estate investment. Dan Fasulo, welcome back to the Commercial Real Estate Show.
Thanks for having me, Michael.
Well, thank you, and appreciate you calling from New York. And we'd like to ask you about the second quarter. What type of volume did you see for U.S. retail properties?
Just under $12 billion worth of retail properties traded in the second quarter. That's up pretty significantly from that same quarter 1 year ago. Retail is a little tricky because we have these mega portfolio transactions that take place from time to time. At this time last year, Blackstone had bought a major portfolio of assets from Central Properties, the Australians. It might be better to look at the first half of this year versus last year, where retail is basically up about 5%, basically flat versus the year ago period. We've hit that point in the cycle where things are starting to plateau as far as transaction activity, and we're really going to need some of the uncertainty in the marketplace to clear up before we get to that next level.
But are we at a healthy level? I mean, how does it compare? How does sales volume compare to, say, pre-recession years? In our pre-recession years, really healthy, the kind of volume we had?
Yeah, I mean, we're obviously well off for transaction activity. We're well off the bottom, which was 2009. That said, we're still less than half. We're seeing less than half of the transaction activity that we saw at the peak in 2007. Part of that has been because of the dearth of financing for some of the larger deals, especially the portfolio transactions that were so prevalent back in the day. And CMBS as a source of financing for the property sector hasn't come back fully as of yet.
Well, Dan, how do investors feel about retail properties in general? So, how does retail investment sales volume compare to, say, office and the industrial sectors?
Yeah, there was a spread between investor interest, activity, even pricing opened up over the last couple of years between kind of office properties and multifamily properties and everything else. And so retail has lagged in this recovery so far, because it's seen, as you said in your intro, it has been hit pretty hard. It's directly related to some of the troubles we've seen on the consumer side. Obviously, the health of the retail sector is directly related to the U.S. Economy, which hasn't seen a full-fledged recovery. And then every month that goes by, you hear about another retailer, anchor retailer that's going out of business. We lost a bunch of them through the downturn. And interestingly, we're watching Best Buy very closely, and the strip centers that are anchored by a Best right now, they're basically we're seeing cap rates blow out for those types of assets.
Right. Well, where are we in the distress market, Dan? Are we past the worst yet? Where are we?
Yeah, in this cycle, RCA has been tracking these distressed retail properties through their entire life cycle. We've tracked just under $70 billion worth of troubled retail properties, and we're about halfway through that bucket at this point. I would say it's fair at this point that we're moving into the later innings of the distress cycle. For the last several quarters, more assets have been leaving distress than are being added to distress. There are still a bunch of major portfolios out there with loans and special servicing. By far, most of the outstanding distress is with assets that have basically put too much financing on them, and those troubled loans are basically in the CMBS universe. So obviously, depending on what happens with the economy, it could trigger additional distress down the road, but all signs are pointing that we're moving into the later innings here. Okay,
maybe the seventh inning stretch, huh? Well, let's talk about the retail property types that investors are most interesting in. What are they buying? Is it single tenant net lease properties? Is it grocery anchored centers? Where's the most activity?
Yeah, there's a lot of different niches in the retail sector. We have seen a pickup in the sales of strip centers. We saw about $5 billion worth of strip centers sell this year, or in the first half, and that's up about 26% year over year if you kind of take out those portfolio activity from 2011. And part of it is that these assets kind of sat on the shelf for a couple of years and didn't really trade, and the yields were looking awfully attractive versus some of the other property sectors. But by and large, it's just kind of well-located, well-leased properties that are changing hands right now. It's grocery-anchored centers. It's centers where an investor can really get comfortable with the anchor. In urban environments, urban retail has been extremely hot. Challenging record high pricing. There's everyone's questioning what the future of the retail format is going to look like, and it's clear that there is tremendous demand from a variety of retailers in having city center locations, and investors have certainly reacted to that demand and are bidding up assets left and right in major CBDs.
And what's that doing to yields? You have this flight to quality. Where are cap rates right now? Are cap rates continuing to be compressed, and is that somewhat because of this flight to quality and more transaction volume there?
Well, I mean, we are still seeing significant cap rate compression in the retail sector. On average, we're just slightly above 7% nationwide. Obviously, it's different if you're in New York or California, where yields have gotten astronomically low once again. It really depends on the niche, Michael. We've seen urban retail properties trade sub 4%, if you believe it. We've seen malls in the center of the country go for 8, 9, 10% or more. But I think for kind of your more institutional product that's well leased and well located, we are seeing kind of cap rates react to the low Treasury rates right now, and it is pulling down cap rates. And investors are certainly willing accept lower cap rates because it's hard to get that yield right now.
Right. Well, we're getting short on the break here, Dan, but what do you expect for cap rates moving forward?
Yeah, I mean, unless there's one of these external factors that we all worry about really blows up, think the Eurozone, think the nonsense in D.C. I don't think it. I don't see any near-term reasons why cap rates are going to move higher. If anything, most of the signs point to more cap rate compression in the near future. If you look at the spread between average cap rates and the 10-year Treasury, we're at a 10-year high right now. Mm-hmm. And yes, I don't believe that the 10-year is going to be at 1.5 forever, but I know that spread's going to close, and it's probably going to be a combination of the 10-year rising and the cap rates coming down. Okay, well, you've heard it here with Dan Fasulo. Thanks for joining us today. My pleasure, Michael. If you'd like more information from RC Analytics, visit rcanalytics.com. Stay tuned. More retail market insight for you. This is America's Commercial Real Estate Show. We'll be right back.